Hello everyone. There's a saying in the markets that the market is like a voting machine in the short run and it is like a weighing machine in the long run. So, how have market participants voted in the short run for the event like budget? Well, there are some aspects of the budget which market participants have voted for or liked, which are that the allocation to national infra, to rural urban infra and national highways, that allocation is up by 18% YOY. Some of the other aspects people have liked is that the target for agricultural credit has been pushed up from 12 lakh crores to 15 lakh crores, which is a jump of about 25% YOY. At the same time, there are aspects of the budget that market participants have voted against or not liked, which are that market participants expected something to come on the stressed NBFC sector. But bear in mind, budget is not the only place where something needs to be done. There are other places or other areas or other times when something could come on the stressed NBFC sector. Some of the market participants have voted or not liked the fact that long-term capital gains tax has not been done away with. Well, we have to live with that. Another aspect of the market which participants have not liked as much is probably the impact on insurance companies, either due to DDT or the taking away of the standard deductions. But bear in mind, people like us or companies like us who believe in protection and long-term savings, the impact on those companies is hardly 1% on their EVs. So life goes on. So it's time to now weigh the markets on the weighing machine, which is the long run. So what has changed for earnings outlook or expectations after the budget? Frankly, nothing. We still expect FY21 to be a mid-teen earnings growth year. However, it is lesser than some of the market participants' expectations of greater than 20% earnings growth. We still believe that the Indian GDP will not grow at 7-8% in the near term. It is still likely to grow somewhere between 5 to 6%, which essentially means there are going to be aspects of the market which will show good earnings growth, and there are going to be aspects of the market which are not going to show good earnings growth. And we believe that till a full-blown economic recovery happens, markets will remain polarized. They will remain polarized to where earnings visibility and earnings acceleration or earnings delivery is there. At the same time, markets are unlikely to gravitate towards sectors which have lesser earnings visibility. The sectors that we like or we believe have good earnings visibility are the large private sector banks, some of the agri-chemical plays which have done well in the last 2-3 years and are likely to do well. One of the aspects of the budget that we told you that the market participants have voted for is that the target for agriculture credit is up by 25%. At the same time, whatever is happening across the world in the form of coronavirus in China is also likely to help some of the agrochemical players in India, where there is likely to be a shift towards Indian companies in the long run. There are some other sectors like telecom, at least some companies in telecom, where the earnings visibility is quite high. There are also some domestic cyclicals where we see some cyclical rebound which are likely to do well. At the same time, the IT and healthcare sectors are the ones which are unlikely to see a lot of buoyancy simply because their earnings growth are unlikely to be more than 10%. We also like the insurance sector, which having corrected provides a good opportunity in our opinion. Some of the companies like us, which have a long-term goal and protection and long-term savings as a concept, those insurance companies are likely to have minimal impact on their EVs because of the changes in the tax structure. In the end, we would like to leave you with a thought that it is not important for us to be smarter than others, but it's more important for us to be more disciplined than others to deliver better returns. Thank you.
Hi, I'm Kunal Shah. I'm here to update you on the budget and its impact on the bond market. First, let me tell you about current year. Government had projected fiscal deficit of 3.3% for fiscal year 2020. However, now government projects the fiscal deficit at 3.8%. Well, because of the lower tax collection and slower GDP growth. The good news is, government is not going to borrow extra for current year because the deficit has been funded by high collection in the small savings fund. Now coming to the next year, Finance Minister now projects fiscal deficit at 3.5% of GDP. We believe the assumptions of revenue collection and expenditure are more realistic, with 12% tax growth assumption and 12% expenditure growth assumption. The nominal GDP growth is now projected at 10% for the next year. Markets will be watchful of the steps taken by government to achieve this tall task, especially the divestments in LIC. Another important aspect in the capital receipt is collection under telecom sector. Government is assuming the spectrum sale of around 20 to 25,000 crores and 90,000 crores of AGR collection. Again, the divestment target and the collection in the telecom market will be watchful of. Coming to the bond market, no extra borrowing, yields have dropped after the budget because bond market were expecting extra borrowing to the tune of 30 to 40,000 crores in the current year. Also for the next year, the gross borrowing target of 7.8 lakh crore is on the expected lines. So bond market will now focus on the monetary policy and the rate action going forward. We believe current high inflation, especially because of higher vegetable prices, will keep monetary policy on hold for next couple of months. Beyond which, if vegetable prices fall, it will open up space for monetary policy to support growth. So currently, the 10-year yield is trading in the range of 6.5 to 6.6. Will continue to drop if inflation falls in the next couple of quarters. We see 10-year yield in the range of 6.25 to 6.75 near term, supported by lower growth, lower inflation, and possibility of inclusion of the Indian bond market into the global benchmarks. For investors with long liability profile, they should continue to match their liability duration with appropriate asset duration to immunize themselves from lower interest rates into the future. Thank you.